Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Global Access Equity Thematic Disruptors Model Portfolio. Now, the goal of this portfolio is to provide exposure to 7 to 12 large trends within the global economy. And Global X has a very unconstrained mandate with regards to selecting themes. And we can have a quick look at the holdings, where we see that the portfolio is comprised of 10 ETFs. Most of them are from Global X, but there's also a few ones from other asset managers like First Trust or Invesco or Defiant. The largest allocation, with around about 15%, is to a data center and digital infrastructure ETF, followed by defense and cloud computing. If you look at the total fee for this portfolio is on the higher side, with 54 basis points, but these thematic ETFs are always on the expensive side. If you look at the performance of this portfolio versus the MSCI ARCRI, which is the benchmark that we select, as well as Global X, we do see that the current portfolio has outperformed the ARCRI. Having said that, we only do have about 1.8 years of track record, which is because some of those ETFs just were launched recently. Now, this is the portfolio performance of the current holdings, not the actual track record. And if you go to the page of the equity thematic model portfolio, we do see the actual track record here versus the benchmark. And what we see since inception in 2017, so we have almost 10 years of data, the model portfolio generated only 6.5% per annum, compared to 11.3% for the benchmark. Stated differently, this model portfolio has brutally underperformed its benchmark. It's almost 50% less. And so what's practically happening is because we see that short-term outperformance of the current portfolio is that Global X is simply performance chasing. They're just selecting whenever they rebalance this month what has done very well. And so the current portfolio will always look good, but as mentioned from the actual track record, you underperform the benchmark by 50%. If we compare the portfolio versus the benchmark, we can do that from an asset class perspective, and we do see some differences. So both is of course 100% equities, but we see, for example, that the model portfolio on Global X has a higher allocation to the US, 75% versus 62% for the MSCI ARCRI. We also see a lower allocation to large caps, 47% versus 81%. If we move to sectors, we do see significant differences. So Global X has a significant underweight in financials versus MSCI ARCRI, and an overweight in healthcare and industrials. And that probably simply reflects that in financials, there's less innovation, less disruption happening than, for example, in healthcare with biotech or industrials, perhaps from defense at the moment. Now, that's from a sectoral perspective. If we move to risk analytics, in terms of seeing what is the core driver of this portfolio, we would expect this simply to be the global stock market. So 77% of the risk of Global X's model portfolio is simply explained by the stock market. We do see minor factor exposures, and also, well, we see 12.5% of the risk is idiosyncratic or unexplained. And that's kind of expected because this portfolio is more concentrated and also has very niche focuses from a thematic perspective. The other point we can ask is, can we reduce the fees of the portfolio? As mentioned, portfolio is quite expensive at 54 basis points. And so, for example, over here we have the Global X Robotics AI ETF, which is charging 68 basis points. And we are recommending to take a fund from Wisdom Tree that's only 10 basis points. If you look at the performance of both of those funds, well, you can actually see that the cheaper one from Wisdom Tree actually outperformed the one from Global X. So, that's perhaps an argument for, well, replacing an expensive fund with a cheaper fund. Having said that, if you do this on portfolio level, replacing every single fund with a cheaper alternative, we do reduce fees from 54 basis points to 21 basis points. but the model portfolio, even despite it being more expensive, has outperformed. So there's no arguments against that. Finally, we can question if we can simplify this portfolio. As mentioned, it has 10 holdings. And again, yes, we can do this by simplifying it into 3 securities, which gives you something that is very close from a Trump perspective, and it would be simply exposure to global stock market, to the tech sector, as well as roughly growth stocks. But it would also have performed lower, and so you could argue the simplified portfolio is inferior. Having said that, and that kind of concludes also our short review of this portfolio, what Global X is doing here is performance chasing. And we can see that this looks great if you use the current holdings, but not if you look at the actual track record, where this is utterly destructive. And performance chasing is just, or thematic investing is just performance chasing with a narrative. Usually jump on a train when, well, performance is there and the storyline fits. The problem is that most investors, including Global X, as the track record highlights, are not particularly good at exiting trends. And there's nothing wrong with performance chasing if done systematically, where it then becomes momentum. But non-systematically, right, like we see in this case, is not a particularly attractive investment strategy. So I hope that helps to get some thoughts on this equity thematic disruptors portfolio, which always looks interesting in terms of the holdings, right? This is themes like security, defense, AI. But as we can see, that the way this is implemented, right, has not been, well, creating value for investors. Hope that helps. Have a nice day.